On May 5, 2026, the cleaner story was not the closing index level. It was the chip complex taking control of the tape. Semiconductors rallied, oil backed off, and investors moved back toward the companies that can turn AI demand into shipped silicon. AMD became the after-close test for that move. First quarter revenue grew 38% to $10.3 billion. Adjusted earnings came in at $1.37 a share, and second quarter revenue guidance centered around $11.2 billion. The number that mattered most was data center revenue, up 57%. That makes matters. AMD is no longer trading only as a PC recovery name. The data center business is now the growth engine, and the market is watching whether EPYC CPUs and Instinct accelerators can keep carrying the story as AI workloads move from training into inference. Amazon gave the same story from the buyer side. Its first quarter sales rose 17% to $181.5 billion. AWS grew 28% to $37.6 billion, and its chip business crossed a $20 billion annual run rate. That says cloud buyers are not just spending on data centers, they are reshaping the chip stack. Custom chips do not end the merchant silicon trade. Big cloud buyers still need compatibility, supply depth, and deployment flexibility. That is why Amazon can build Graviton and Trainium, while AMD, NVIDIA, and the wider hardware chain still matter. Palantir showed the other side of the market. U.S. commercial revenue grew 133% year-over-year in the first quarter, but the stock still fell on May 5th. The market was not rejecting AI software. It was saying valuation matters more when expectations are already extreme. That split is useful. Hardware names were being rewarded for demand, capacity, and guidance. Software names had to fight a higher bar on valuation. The AI trade did not disappear. It became more selective, and semiconductors were where buyers showed the most confidence. Oil helped the move. Brent crude fell back to about $110 after briefly pushing above $115 on Monday. That gave growth stocks room to breathe. But oil is still far above pre-war levels, so the relief is tactical, not a full reset. The macro data did not clear the Fed. Services growth slowed, inflation pressure did not vanish, and job openings stayed firmer than expected. Lower oil helped yields ease, but it did not create an obvious case for quick rate cuts. The consumer risk sits in gasoline. Wholesale moves and tight inventories can hit pump prices with a lag, especially when crude stays elevated. If gasoline rises again, the chip-led rally has to prove it can survive pressure on household spending. Away from the chip move, private credit remained a background stress point. Blue Owl non-traded credit funds faced heavy redemption requests and used quarterly caps to limit withdrawals. That is not a market crash signal by itself, but it is a reminder that illiquid products behave differently when cash gets nervous. Income products deserve the same second look. Some BDCs use loan floors that can protect net investment income if rates fall. Covered call funds can produce high payouts, but return of capital treatment can create tax issues later. Yield alone is not enough information. The next confirmation comes from the chip chain. Watch AMD's post-earnings reaction, whether data center guidance keeps improving, whether cloud buyers keep spending on custom and merchant silicon, and whether more stocks join the rally. May 5 was not just about records, it was about semis taking the baton.